Well, good evening and welcome investors to our January 2023 Investing Roundtable. That is a tribute to the Economic Forum, the World Economic Forum. And I don't know, I must have missed my invitation in the mail. Did any of you guys get invitations to Davos?
I just want to get an invitation to spring training.
I'll
I'm
second that
headed there
motion.
in a few weeks.
Switzerland in December. That kind of sounds like New Orleans in August, Mark, you know?
Yeah, that could be the situation. Anyhow, welcome everybody. My name is Mark Robertson. I am founder and managing partner of Manifest Investing. We're one of the co-sponsors for this event. I also volunteer for the Mid-Michigan chapter of Better Investing. Joined here by some dear colleagues, starting with the guy on the left there, Ken Cavola, who's also with the Mid-Michigan chapter. Good evening, Ken.
Good evening, Mark. Good evening, everybody. We're so happy to be able to provide this program for you. We're coming up on a really important anniversary next month, so stay tuned for one more month for our black tie affair.
Yeah, we should have some fun with that also. And from Atlanta, wearing an Atlanta Braves tie, by the way, our dear friend Cy Lynch. Good evening, Cy.
Good evening, Mark, Ken, and everybody. Glad to be here.
Welcome. Now, Hugh had mentioned that he was going to try to join us, but there was a fairly low probability, but he may stumble into the room, so we'll keep our ears open for any Irish brogue. And we've invited Kevin Gologly here tonight to join us. Kevin is a native of Chicago. He's been in a couple of our other programs, and, well, we'd like to hear from Kevin tonight. How are you, sir?
I'm doing fine, and I can be your substitute Irishman if Hugh can't be there.
Awesome.
I'm thinking this is the first time that the entire panel is wearing ties on the opening slide, Mark. We're really in formal wear tonight almost, you know?
It's kind of a Davos requirement.
Okay.
Anyhow, in the donkey there, you can take it one of two ways. One, it's either a tribute to the World Economic Forum. Either that, or it's just simply a nod to the discussion we had on Don Quixote this afternoon. And Ken, do you want to hit the audience with the quiz?
Well, sure. We asked our audience if they could name. We were looking at the famous statue of Don Quixote, and he's being followed by his retainer, who's riding a donkey. And we asked, first of all, if anybody knew the name of the retainer, and a lot of folks knew Pancho's name, but did anybody know the name of Pancho's donkey? And so far we haven't gotten a correct answer. So if any of you know the name of the donkey in Don Quixote that follows Don and his horse around, we'll give you bragging rights to have it right correctly the first time. We did get the name of Don Quixote's horse, but we have not got the name of Pancho's donkey yet. So if you can come up with that during the program, just type it in there and we'll see how you fare. It's not Donkey Hole nor Hoti. No, Marie, I'm sorry.
All right. Pressing on.
Are they able to use the Google search, or do they got to come up with it in their own memory bank?
Well, we had two people trying to use the Google search, and even they got it wrong. So
that doesn't say much for our audience. I hope the adult beverages are not too much out of control at this point.
All right. Oh my goodness, Dennis and Don and Diane and Jane all gave me and Cheryl, everybody Googled really quickly, okay?
It's a hot.
Dennis said ass in 9, and Dennis, you're wrong, okay? But the rest of you that said Dapple, you were correct. It's Dapple.
All right. No more asinine interruptions.
No more.
That was a pun. All right. No investment recommendations intended. There's a lot of very familiar names, so you guys all know the drill, but in case you are here for the first time, big welcome to you. Everything we do here is for education and demonstration. We try to illustrate some philosophies, methods, and techniques of the modern investment club movement. You will be hearing our interpretations, our deployment of those things, those processes and techniques, and we'll be expressing some opinions. Please do your own homework, your thorough own homework before making a decision about anything talked about here tonight. We do try to disclose if we actually own something. If you'd like to be on the email reminder list for these sessions, which are monthly, please send an email to ncavula1@comcast.net. And if you'd like copies of the slides, or if you have follow-up questions, you can contact either one of us at those 2 email addresses on your screen. Okay, all set, Ken?
We're all set, Mark,
All
and
right.
looks like our audience is all set as well.
They're ready to go. We need to roll. I mean, that is the Swiss Alps there. We are in the shadow of the Swiss Alps. Here's our standing agenda. Again, welcome if you're here for the first time or a relative newcomer. Any discussion will probably center around our Groundhog Challenge. There's a little bit more on that to follow. We will talk about our performance results, talk about any stocks which may be on a hot seat of sorts. But the 4 stock presentations will be, as shown there, Clearfield, First Foundation, Darling, and Lululemon Athletica. We do have a poll at the end. Even if you're here for the first time, we do encourage everybody in attendance to vote on one of the 4, and then we actually add that to the tracking portfolio as an audience selected position. We do try to leave room for Q&A, but we're not very good at leaving a whole lot of time at the end of the sessions. Here's just a little summary of what we've been doing for almost 13 years now. We're just here to share an idea, go through the analysis of that idea. We keep track of the ideas that we discuss here for the last 12 and a half years. The objective is to beat the market by 5 percentage points. That's 500 basis points if you speak that language. And we measure the total stock market by the Wilshire 5000. We'd also like to see 50 to 60% of our selections outperform the total stock market index after selection. We'll kick off with kind of a magic statistic and a teaser to invite you back a month from now. The February roundtable is our black tie affair. You can come in your jammies and bring your own beverage. But a month from now, and we typically do open the door to the green room a little bit early for some open discussion. But up at the top of this page, the average relative return for the stuff we've done during the last calendar year stands at plus 16%, 16.7. And that's a jaw-dropping number when you consider how tough the slog has been over the last year. So come and we'll actually detail where that number came from. Any thoughts or comments, Ken?
I just think it's a wonderful number, especially coming from some pretty normal people. I mean, when it's all said and done, none of the 4 of us make a living from the stock market, and I think it's interesting that we can turn out numbers like this number on a relatively regular basis. It just makes me feel kind of good.
Cool. Here's what that number has helped us to do over the last year. And during kind of a challenging time, and again, we measure everything relative, more on that in a second, but what you're looking at is the track record of the rate of return, but it's a relative return. So it's actually the answer to the question, how well did you do versus the stock market? If you simply generated a stock market rate of return, actually matched it, that would come in at 0, as shown here. Okay, so we're basically measuring the performance of the tracking portfolio, and you can see that since year 3, and basically for the last 10 years, we have managed to generate a performance which has been at or above this objective line of beating the market by 5%. The calculation is shown right up here. Our rate of return on an absolute measure is 15%. The market over that same time for matching or mirroring investments checks in at 9.7. So it literally is 15 minus 9.7 equals that. That is the number that is plotted right there. So that's what it comes down to. And our outperformance accuracy, the majority by a slim margin have actually outperformed the market from the time of selection, which that's actually a pretty high number. Any thoughts, or should we keep pressing on?
Let's keep pressing on, Mark. We have a lot to cover tonight.
Yep. Here's the tracking portfolio. These are the top 20 positions in the portfolio. If you want to look at all of the active positions in it, you can actually use this link down at the bottom. You do not have to be a subscriber at Manifest Investing to access this link, and you can actually explore every single position. Anytime that a knight or a guest damsel or the audience selects a stock, we invest $1,000 into it. So in the case of Microsoft, Microsoft has been invested in 5 times. You see that up here from the legend. So $5,000 invested has become this number. Now, Microsoft, after the bell tonight, reported earnings. It immediately went up, I believe, 4 to 6%. And I think it actually sagged back down to where it was in the red in after hours trading. So make for an interesting read. But it actually went from 242 to 250 something in after hours today.
I think what's interesting about Microsoft, Mark, is that we haven't had to tap it on a regular basis to move it to the top of the list. It only has 5 lots in it, if you will. The rest of the top of the list there is considerably higher when it comes to number of times we've had to tap it. Cognizant 15 times, Alphabet 12 times, Booking 11 times, Ardelyx 10 times, MKSI 10 times. So that 5 times choice, and then to have it be almost 3 times as large as the next largest holding really says something about the quality of that particular investment.
Absolutely. And once again, we have to say thank you to Cy for Cognizant and EPAM. Those are cousins or brothers from a different brothers or something, whatever you say to that.
Well, we shouldn't leave out MKSI either.
Yeah, he sneaks that one in there too. He likes lasers. He likes
Yep.
IT companies. So thank you, Cy.
And we'll do a big thank you to Hugh for one single choice of Costco, and Costco stubbornly stays on this top 20 list, even though it has only 1 lot in the entire time that we've been doing the roundtable.
Yeah, and Amazon is just 2. Anyhow,
Mark, one thing that I've noticed is that I'm surprised Cy hasn't put Liberty Braves on here.
he's tried.
To look at.
Yeah, if they were owned by a subsidiary of an IT company, they'd be in here in a heartbeat.
Yeah.
So when EPAM buys them out, huh?
Yep.
Right. There you go.
All right, we'll keep pressing on then. Here's a look at the overall portfolio. We actually have a slight, I would say, an artificially high growth there. We're aiming for 12% plus or minus. That's actually pumped up by Ardelyx. More on that probably over the next few months as that company comes into maturity. But the portfolio has plenty of quality, a little bit short on projected return. At 10, we'd like to shoot for 15. That 10 up there is basically the average of all the companies that we cover in our universe, which is nearly 3,000 companies. So it's a little bit light on that. So we basically just want to be boosting the projected annual return as we can. Every month we go ahead, sir.
Mark, I'm going to show them some different numbers in just a moment. Does that mean that the public portfolio link contains a few more holdings than the link that we're using to get these numbers?
Well, we'll see. That could be just a matter of the update and just the change in when you took your snapshot.
Okay, could very well be.
I mean, quite a few stocks moved around considerably. Look at Microsoft alone, moved fairly considerably. All right, so the other thing that we do every month, and we call it the challenge process or the hot seat stock, however you want to think of it, we basically take the portfolio and sort 4 companies from lowest projected annual return. And there's only one company below 5% in the portfolio, that's D.R. Horton. And fairly decent run with D.R. Horton for us. I certainly don't think that it's a sell candidate, and I simply wanted to point the audience to a session we did just a week ago, our bull sessions last Tuesday, where we talked about the entire housing industry, and of course with D.R. Horton's being the largest residential construction company by market cap. We spent a few moments on that, but we think that the characteristics for housing in general, maybe not over the short term or the intermediate, but longer term, look pretty good. Anything you want to add to that, Ken?
Well, only I really challenge the folks in the analyst community for any of them to give me a really solid projection 5 years in the future for a housing stock. I think until the Federal Reserve stops doing what it's doing and settles us down a little bit, I don't think we're going to be able to get a really good read on where housing stocks are going to move. I've kind of suspended them from my thinking for the moment, even though I still think they're long-term great investments to take a look at.
Yeah, and I do think you have to be selective, but I do think there still is long-term opportunity there in that group.
Mark, we have a question from Victoria, and I'm going to unmute her. And Victoria, you're muted on your side. If you want to speak to us, you'll have to unmute yourself. Victoria, you'll need to unmute yourself, or I'm going to decide it's a inadvertent hand in the air and go on. I'm going to keep moving then, Mark, okay?
Okay, one of the other things that we do check in on, again, this is just meant to be a flag, much like a penalty flag might be thrown on a football field or a timeout for a misbehaving grandchild. We basically compare how the stock is done versus the market since the time it was actually chosen. Anytime that number starts getting above 20, 30, 40%, we do hold up our hand and say, does this company deserve a timeout? Fortunately, most of the companies are behaving fairly well. You can see that last month we actually did walk away from a position in Generac, but we also had these 30s and 40s. Notice that there's no 30s and 40s on this list. So basically, we'll just keep cruising along.
I think it's interesting, Mark, that we're going to actually present a stock that's on our relative return. One of the lots, if you will, is on our relative return list as having a negative almost 26% relative return. I still believe that First Foundation is one great company to look at, and I know with Cy presenting it tonight, he must believe the same thing. But buying it at $20 might have been buying it a little bit too richly.
Well, it's just an opportunity to demonstrate if we liked it at 20, we have to really like it at 15. Okay.
Yes, and I just point out because and y'all know that I struggle with this particular measure, and I don't mind looking at it. I just am not a fan of rigidly applying it, and I think over time we've gotten less rigid in attempting. But notice 10% total return or relative return in MKSI over the last month. And I just, for jollies, would be curious to see how that compares with the rest of the portfolio.
Yeah, it's actually got quite
which is, you know, if we had dumped it last month, you would have given that up.
Yeah.
And I've asked myself some serious questions about this particular measure also during a market that is unusual, to say the least, a market that really moves very quickly in both directions and seems to move in those opposite directions without any real impetus being made by anything to make it happen. I'm just wondering if a snapshot in a moment of time should be the one deciding factor to get us to keep or to lose a holding from the portfolio. I think that this particular idea worked really well when the market was well behaved or relatively well behaved 5, 6, 7 years ago, and I'm just not certain about it today. And I know that we've pounded it back and forth with Cy being on the negative end of it and Mark being on the very positive end of it, and and I'm kind of standing in the middle, being kind of wishy-washy about it a lot of times.
Uh,
So
let's go ahead and table the discussion for now, but I'll just fire one last shot across the bow. I think maybe the problem or the challenge or slash opportunity lies in the notion of, you know, how we treat stocks when we buy and sell them as core or non-core. I think a single threshold is probably where part of the problem is. We can't, 20, 25, 30% on a negative relative return. That probably needs to be scaled by quality. The other thing I have to point out is when we have made these type of decisions and compared what would have happened if we hadn't done that. Now, you're going to have exceptions and uncomfortable moments when a company goes up after you take action, but we've actually
absolutely,
seen
yeah.
3 to 4 percentage points better. I mean, keep in mind that we've had situations where we were prevented from losing 95% in a holding because we took this action. So again, it's a topic that needs further explanation and exploration, and
And I agree
logic.
with you, Mark. I think we started talking a couple months ago about the fact that maybe we need two rules, one of them for core stocks and one
Yeah,
of them for non-core stocks.
I do
Yeah, I
think we
agree
need
with
to
you.
look at that. All right,
Yeah.
here we basically went looking for companies that might be accumulation targets because the relative strength index has dropped below 30. That just simply means that the stock has been pummeled. A lot of the aerospace and defense stocks have been pummeled lately, and I'm not so sure there isn't some opportunity there. Pfizer's also taken a kind of some heat here lately, and a look at Pfizer here, just real quickly. I want to basically walk away from the position. We started this one in June 2020. I've actually had a pretty nice result here. It actually beats the market by a considerable margin over that time frame. I'm just concerned over the story. They're kind of wrapped up in the mystery of COVID and vaccines. Not going to tell you what I think, but I just think I don't need the drama and the mystery in my life. I just want to walk away with a win. So we'll exit the position. I think it's a mixed bag at this point. If you basically take and set aside the COVID bump here, and you basically look at the trend that's in place, you're looking at a low growth stock. So, Cy, I'm trying to win you over with this one. We basically want to get some of those low growth stocks out of the portfolio. But, I mean, that's a plus. But again, I just think they're vulnerable to some real nastiness. So we'll just do that. Don't even need to vote. I'm just taking my stock off mine off the table.
Picking up your baseball and walking away with it, huh, Mark? Okay.
Could be looked at that way. So with that, let's go ahead.
Hypodermic needle something.
Yeah.
All right, Ken, why don't you go ahead and take us away? This is the different numbers you were talking about just a minute ago. I don't think they're that much
Right.
different.
Okay, when I was making these slides, and I was doing this relatively recently, but of course you can't do it at the exact same time that everybody else is doing it. Our portfolio showed an average return of 10.6. That's that MyPar number up there. The sweet spot, which is just 5 points above whatever MyPar is, that's the advice that Better Investing has been giving us ever since its founding, that Better Investing feels that we can, a good club, a good individual, somebody managing a good, well-managed portfolio can shoot for that +5 to the market. And Nicholson was quite clear that by the time you're talking about +10 to the market, you're talking about something that has very low probability. It doesn't happen very often. It's very difficult to do, and it's especially difficult to maintain anything more than 10 to the market. So you have your sweet spot, and the portfolio's average at the time I took this snapshot was 13.2. That means that I'd like to move the par up. And the way that I can do that is, number one, I could move stocks that have a par less than 13.2 out of the portfolio, like Pfizer, right? Or we could move stocks into the portfolio that have a par greater than 13.2. So that's what I went looking for, what I went searching for. About every 3 or 4 weeks, next slide, please, Mark. About every 3 or 4 weeks, I moved to my Better Investing, SSG Plus. And I don't fool around too much with the main screener, which on the screening page would be off to the left of these predefined screens. But I like every 3 or 4 weeks to run this small company screen. In the last couple of years, it's yielded anywhere from 5 companies to as many as a dozen companies. When I ran this screen just a couple days ago, it gave me 6 companies to consider. One of them happens to be a Chinese company, a fairly young Chinese company, and I quickly drew a line through that. That was the Highwind Holdings, the third one on the list. I ended up with a couple of banks. I ended up with a stock that's on our best small company list that Mark and I put together and put out every October. That's InMode. And I ended up with a stock that I didn't really know very much about, and that was Clearfield, CLFD. And so I said, well, you know, if this thing checks out, this might be a wonderful company to add to our list. I know that small companies tend to give me par values that are at least at 12% or better, and many times at 15% or better. And this is a classic small company growing very quickly. Next slide, please. So I went to Clearfield. CLFD, again, is the ticker for it. And maybe you can tell what it does by the picture at the top of the slide, but I'll tell you, I certainly could not tell what it was doing by that picture. It's a pretty picture, but I wasn't quite sure what Clearfield did. So I began to look at the website of the company. That's one of my most favorite sources. I found some of Clearfield's customers. Clearfield doesn't really do a lot of business with individuals, although we will find that in a way it does, but it does a lot of business with other businesses. And you can see from the partial list of their 1,200 plus customer base that it deals with some of the biggies in the communication industry. And what I liked was that Clearfield was providing fiber, glass fiber, for the creation of these brand new high speed networks that were being developed all through the world, some of them labeled 5G. Some of you might be familiar with that vocabulary, but they don't only develop the fiber, they develop all the different accoutrements that go with fiber. So the connectors and the boxes that hold those things, and the way that you protect the fiber, and anything that has to do with the creation of these fiber networks. Clearfield is making those products, packaging them in different units and different variations, and then selling them to all kinds of customers throughout the world. Next slide, Mark. Their target markets, and this website was prone to the use of a lot of letters, so I had to kind of look them up. One of their biggest customers is FTTH, and I found out that means fiber to the home. So if you're lucky enough to be connected to a high-speed fiber network directly to your home, you might be using Clearfield's equipment or cable or any combination thereof. They do a fantastic amount of their business in business services. That's one of their largest of the 4 groups right there. Also an awful lot of work in wireless, and we'll get some numbers in just a second to give you some idea of the scope of this business. And then their last big area of business is MDU/MTU. That means service to multi-dwelling units, think apartment buildings, things like that, and then to multi-tenant units, think large skyscrapers, think office buildings, and that sort of situation. So wherever there's fiber going in the next 10, 15 years, Clearfield wants to be a part and wants to play an important part in supplying the equipment to make those networks function. Next slide. You can see the size of some of these markets. Fiber to the home is a more than $12 billion market. You can see the compounded annual growth rate of the 5G market itself. That's a 48% approximate growth rate from 2022, from last year through 2030. The growth of the 5 generation market, the 5G market, is just exploding now around the country and around the world. And they would like, Clearfield would like a piece of that. They've committed fiber now to over 60 million homes, and they'd like to take advantage of the subsidies that are being created by our own government, $100 billion in U.S. subsidies for broadband. And they'd like to target 100% of the dwellings and of the office buildings and the apartment buildings, wherever the internet might reside. They'd like to commit fiber to those, and that's a goal by 2030 of the current Biden administration. So you can see that there's some powerful growth drivers helping Clearfield to really create a very robust, fast-growing business. Next slide. Here's just pictures of the kinds of things they do, and it's much more than just the wire you would expect on the extreme right of the slide there. They're showing pictures of some of their different kinds of cables, but it's all of the connectors and the kinds of equipment that you have to make the wire come together, and then to make it split into different pieces, to be able to monitor the systems and all the different brand names that go into that. Two of the most important brand names for Clearfield are FieldSmart and Clearview. These are what you might see actually labeled on the pieces of equipment if you had to go down to the rooms where you might find the equipment in an office building, for example. They like to play in the space of the semi-rural to rural parts of this country. They're perfectly happy to leave some of the wiring of the big cities to other companies, but they like to play in the space where right now they're the only provider, or maybe they have one competitor, and they're moving this network of fiber optics out into the rest of the country. And whether we realize it or not, most of the country is pretty rural, even though most of the population of the country tends to live in the cities. You can read the value propositions for themselves, but Clearfield likes to make it clear that basically they're faster to use their equipment, and it's easier for them to install that equipment. So they're making the argument. I don't work in that field, so I couldn't tell you how valid it is, but for them to make that argument means they must believe it themselves. I go to the SSG pretty quickly after I find out what the company does and read a little bit about its finances. And here's a good solid picture of the company. Obviously, since it's a small company, it's been growing extremely rapidly since 2017. That bumpier line, flatter line, fairly typical of a small company when it first gets started. What I like is there is a blue line. And the blue line means they're actually earning money for the product that they're providing. And that red tick on the most recent IBAR suggests that they're trading in the middle of their trading range right now. Look at the percentage growth for the company in the most recent quarter. Of course, I wouldn't expect growth like that to continue at plus 100%. But the very fact that the company was growing like that in the most recent quarter and appears to have been growing at really, really high rates percentage-wise since 2017 leads me to kind of covet the company and what it might turn into if I give it some more time. The Morningstar analyst consensus number for 2 years sales growth is at 27%. You can read that right off of the tool as you open it up and take a look at it. That's pretty healthy growth no matter what the company is concerned. And let's go to the next slide real quickly. What I've done is I've added the 2-year sales estimates as open dots going forward, and I've added the 2 years going forward for earnings per share estimates of growth. I've done that by just looking in the legend and clicking on those bottom 2 ideas down there in the legend. They're giving me some idea where that growth's going to go. And then since I don't have a lot of major source material to use as backup besides these Morningstar numbers and the historical numbers, I've decided to kind of look just at the last 5 years growth. That's from 2018 through 22, and then look at the historical numbers and come up with some growth that I think might be appropriate and on the conservative side. I forecast sales growth at 20%, and I forecast earnings growth at 18%. Earnings growth at 18%, by the way, would take me to that $8 plus, $8 and change earnings per share number out in 2027. I look carefully through the evaluation of management, and I don't really see any troubles. I did come up with a good explanation for the fairly large increase in debt from 21 to 22. This was a pretty large acquisition of a Finnish company that does the same kind of thing that Clearfield does, only it does most of that work in Northern Europe. And Clearfield is very clear in its idea of wanting to grow worldwide, not just be a United States or a North American company. So I'm explaining without too much trouble the increase in debt. I like the return on equity number. I think it's very strong. And I like the trend in pre-tax profit. This is the kind of explosive growth that you might consider happening in a very small company. We've talked about explosive growth a number of times at the roundtable and at our bull sessions that we run every Tuesday afternoon. And growth going from around 7% in 2017-18 to about 23-24% in 2022 certainly shows that the company has something going for it. It won't be able to maintain that kind of growth for long periods of time. And therefore, I'm backing the growth off a little bit and making my estimates going forward. Next slide, Mark. I'm looking at the PEs, and I'm astounded that the PEs are in my mind, for this kind of growth, really fairly reasonable. A current PE of about 21, 22, a 5-year average PE of just 30, 31. And I've set that 5-year average as the high average going forward. And I've decided on 16 as the low average going forward. Gives me a good solid buy with a real nice 8.5 to 1 upside downside. Next slide, Mark. Here's a concluding results box that comes right off of the SSG Plus, using those growth figures of 20 and 18, those PEs of 30 and 18, giving me these values right here, that total return number of 26.2, that par number of 19.7, and I always use Manifest Investing to help me decide whether there's some validity to my own assumptions. And Manifest, the analysts that Manifest use to come up with the Manifest numbers are suggesting par of about 24. I certainly think that's in the ballpark. I think my SSG is a little bit on the conservative side where I like to have it. And when I can stay conservative and still get par returns above 15%, I'm feeling really good about the stock. So I'm suggesting we add a position in Clearfield as we move the portfolio forward. And now I'll be very interested to learn what the heck this is in the first place here, this hot stove idea. So turn it over to Cy.
All right. Well, thank you, Ken. For those of you who do not recognize the logo, that is the MLB Major League Baseball logo, a batter ready to hit the ball. And hot stove is what you gather around during the winter time when you're not playing baseball, but you want to talk about baseball. And you talk about the various trades being made or not made or have been made or may be made and who's going to play what position and the like, because baseball is a year-round sport for
Absolutely.
aficionados.
So
It's like the endless conversation that goes on around the teacher's lounge tables then, right, Mark?
Yep.
Okay, all right.
I was going to say it was basically what Sports Talk Radio was before there was Sports Talk Radio.
Yes, there you go. Absolutely. I think that's another good comparison, Kevin. All right. Before we jump into First Foundation, and I'll move through the slides pretty quickly because I mentioned this company 2 months ago, and I've left the most of the slides the same for reference sake, but we don't need to cover them in great detail. Also, do remember though, two endorsements beyond mine tonight. You heard Ken say that it's an excellent company. A good
At 20.
value bank. Maybe he was a little early in it, but it's
So
good today.
you want them to not vote for mine, but vote for yours, Cy? Is that what you're saying?
There you go.
Okay,
And
we
just
got
in
it.
case you need to break the tie between us tonight or whatever, remember in November, our resident bank examiner and, well, not analyst, but he is an analyst more so than we are when it comes to bank. Ross Meredith also said that this is a good time to be fishing in the banking field. And he was glad to see me mention First Foundation that night. I'm not going to quite say that Ross said that First Foundation is the very best of the best, but
That stove's getting plenty hot.
yes, absolutely. So here is First Foundation. You could see the lines. There's an extra one that I put on there for total assets, which is a nice second check, second opinion, double check to look at for banks. You want to see the asset line rising along with particularly the revenues line, but the other lines as well. If there's a disconnect with revenues rising faster than assets, there could be some red flags that you want to see. As you can see here, it's all in all relatively straight and parallel, certainly up. Notice a bit of a dip in earnings in the third quarter. I'll mention that as we go through. Next slide. I just decided that this month I would pick something from an existing holding. So I took the portfolio, ranked it by par, and First Foundation came up as the third highest pick. And on these holdings, it's one that I'm familiar with and generally, and have at least followed. I don't follow it super regularly as I don't own it or have it in any model portfolio that I deal with or club portfolio, but I'm familiar with it. So I said, let's go with it. Notice also, and keep these in the back of your mind as we go forward, manifest consensus growth for First Foundation is 17.8%, and it has a very good to excellent, actually it is excellent, but a solid financial strength at 83%, which I think is important in this stock market, but in particular, you want to keep watching that when you're looking at banks and potentially out of favor companies. Next slide. Just a quick industry study and comparison ranked by par. You see First Foundation is the highest among regional banks. It's also the highest growth rate among regional banks. And I believe it is the one of two, and you could see two highest with ranked by quality, and then in the at least the green par. I didn't put that slide up. First Foundation ranks around 10th or so in quality among regional banks, but of course is an outstanding quality stock at 91%. Next slide. Here's what the company does. It started out in the wealth management business. It's expanded into banking, and they still concentrate on commercial banking, which is business banking plus wealth management. And you can see kind of their four areas of business. They do a lot of loans for commercial real estate and multifamily residential real estate. And we'll see that broken out in some of the detailed slides. Next slide. As they say, commercial banking is their core. They do commercial lending and also deposit solicitation from businesses, and then have wealth management, and they're got their consistent profitability. Notice good solid return on average assets, even in the down quarter of third quarter 2022. That's the bottom bullets, bottom set of bullets. Return ROAA, that's return on average assets, is 1.13, which is good. Also notice the efficiency ratio, which that is a measure of profitability for banks, comparing their fixed costs, their non-deposit, non-financial related costs. Next slide. They started on the West Coast in California, and they moved their headquarters to the Dallas area last year. And you could see that they have branch offices in 5 states, 5 relatively high growth states as well. Most of their loans right now is in California, and then spread in the rest. And I'll let you study on your own time the metro areas and the like. Next slide. I mentioned the multifamily residential loans. They also do single family residential loans, and this is the bulk of their loan portfolio. So it's important to look at how safe the portfolio is. Notice that their average loan to value ratio, that is the loan value compared to the appraised value of the property, is running right around 50%, which gives them a significant cushion in the event of needing to foreclose or have some sort of distressed sale. And notice their delinquency rate is 0 on the multifamily and quite low for single family. Next slide. This is just a chart giving more detail on their credit quality. Again, quite low even in the latest years for non-performing loans, and well below the peer average. Next slide. Here is their net interest income and the growth. Net interest income is simply the difference between a bank's interest income, what it makes in interest on its loans and any other investments, minus their interest costs for deposit accounts or otherwise in difference. And they've done a pretty good job of maintaining net interest income over the last couple of years. Next slide. Here are our stock selection guide profitabilities, and this is where I'll focus my talk a little bit. A question that you may have is, if First Foundation is such a solid company, why has the price been beaten up so much? First of all, right now, banks are somewhat out of favor with the market because of the rising interest rate environment. And so the market is skeptical or unenthusiastic about banks as a whole. That's part of it. The other thing with First Foundation specifically is they have come under fire from an activist investor who likes to invest in regional banks and then sometimes seek to persuade management to do things. They are under fire by such an activist investor right now with Driver Capital, who actually, I believe, has proposed 2 director candidates to the board of directors for the annual meeting in 2023. And what attracted him to the company and is that I asked you to remember the drop in earnings for the third quarter. They dropped earnings, and he believes that perhaps the rising interest rate environment is going to hit First Foundation particularly hard. So that's one reason, and the price did drop after that. The other reason is that there has been some management turnover. The longtime CEO has taken over as the president of the company. The president left in early November, and the CFO, who became the acting president, left in later November. So there's been some restructuring in the company. No, I could find absolutely no evidence of any sort of concern over anything untoward going on. In fact, as I mentioned, the CEO, longtime CEO, chief executive, took over as president, and that's who the board feels is the appropriate leader. But management change certainly brings uncertainty. And so that also caused a bit of a price drop. I mentioned that I featured the company in November. The price has risen several points since November. So since the bad news of the bad third quarter report came out in October, and then the management turnover in November, the market is actually turning back toward First Foundation, and even the investor himself says he's not trying to disrupt the company and get them to sell it off. He thinks it's a solid company. It's just undervalued, and he wants to shake management up a bit to get them to bring the value up. It's actually currently below its tangible book value. Next slide. Here's the company slide on the various measures I've already mentioned. Return on assets, you can see the efficiency ratio that I mentioned as well. And then our SSG tracks earnings per share and return on equity. This is a slightly different measure. It's tangible equity, which return on equity can include intangibles as well. Next slide. Here's why they say you should invest in it. I just say it's been beaten up. It's a solid company. It's going to take some patience because there's going to be uncertainty in the next few months, but long term, I believe that First Foundation will give above average return. Next slide. Because of the uncertainties, I used a bit of a worst case scenario analysis. I did that in November and I carried it over this time, projecting sales growth or revenue growth of just 10%, expenses at the 5-year average of 41.7 pre-tax profit. Pre-tax profit in the last fiscal year was not well over, it was about 51.7%. It was over 50%. So that's a significant reduction from the current level. Yet, again, with the uptick in interest rates and some of the challenges facing the company, I think that using a lower profit margin is reasonable. But again, since, as I said, this is kind of worst case scenario, I did that. Carrying all that over leads to earnings per share of $2.91, which is about half the manifest consensus number. Next slide. Using those numbers and a high PE of 12, an average PE of 8, you get a 19.1 potential return on the upside. Again, this is a worst case scenario. The projected average rate of return is a bit on the low side for what I'd call a normal SSG, but I'm not at all concerned about it being a worst case scenario. And of course, notice that the manifest par using the average PE is between 2.5 and 3 times as high. So there's significant upside over and above my intentionally pessimistic projections. So I'm adding another 1,000.
Okay. Thanks, Si.
Oh, look at that beautiful photo.
Portillo sneaks
Hey,
back into the
Say, Si, we had one question on your presentation. I don't know if you wanted to take it, but one person was asking about the Morningstar financial health grade on the front was a D. Does that concern you at all?
Does Morningstar track?
They have grades that you can see it both in the
Right.
screener on the left, but then they also put it with the latest updates in the summertime where the company description is. There's they'll show the financial health grade there, which is different than their wide moat and their exemplary.
Right.
stuff.
Right. I'm familiar with the grade. I just was not sure that Morningstar covered.
Well, it's a stock grade. It's basically their financial health grade. They have one for financial health, one for profitability.
But Morningstar has their quantitative reports and they have their analyst reports, and they give the grades, I believe, only on the analyst reports. And I did not know that Morningstar did that for First Foundation. I would have to look closer on that.
Yeah.
We'll take a look and come back to that next month, perhaps.
Yep.
Because who
Yes.
knows, Ken will probably wander in and want to double down on that one next month. All right.
Well,
Take it away, sir.
I heard you guys at the bull session saying you had 3, maybe 4 presenters, and I said I just did this one last week for that's my club, one of my 2 clubs, the Montgomery County, Maryland Model Investment Club. So there we are at our summer social, and we usually play a game where you can win with your best stock advice, and usually it ends when someone says Ken Kavula said, and that sort of ends everything, and you end up winning everything out there. But yeah, so come see us on the 3rd Wednesday of the month. We're online. Enough for a promotion there. But I just updated the stuff with today's price. But other than that, it's the same one I gave to my club last week, and I see a couple of them are in the audience tonight. So let's go to our next slide. I won't read this to you. You can read that yourself. But I wanted to be able to, I don't have a slide to be able to talk about where I found this. And, you know, like Ken did, I like to look, I will look at those predefined screens. I found this on the roster equality. I look for it sometimes by using those Morningstar stock grades that are in the custom part on the left-hand side, but it also shows up in the those in the selection opinion of value line where they have their highest growth companies, ones that are looking pretty good, and some of it's in there along with things like Google and Adobe and Microsoft and Littelfuse and MasterCard. So it hits a really good spot. And I like it because I really like stuff in the S&P 400 to find. And I get a nice good core score on it. And as I'll show you a little bit later, it has a potential coiled spring. So that all gets me sort of interested. Let's go to our next slide. This is you can, if you get the slides, that's a hyperlink to to YouTube and an audiobook of One Up on Wall Street, and he talks about his 13 attributes of a winning stock. And then I found a blog where someone did it, and those things that are highlighted in yellow there, this all fits Darling. It sounds dull and boring. It does work. It's dull and boring. It has a disagreeable function. It's in the food rendering business. It takes food byproduct. So there can't be anything grosser than that. Analysts don't follow it. We don't really just have quantitative numbers from CFRA and from Morningstar. And there are rumors about the company being involved with toxic waste or the mafia. Well, it's not toxic waste, but animal rendering products is probably right up there with toxic waste. So we've got the perfect storm as a potential for it. So let's go to our next slide. Again, I won't do this, but I'm going to go against the grain with Peter Lynch, where he always says, you know, the cheaper the paper, the more important the information. In the modern day, I like trying to find videos from the company that sort of help explain it. And they have a really nice one here on Darling. And they talk about some of the things they're doing, like black fly larvae and growing it on a commercial scale so that they can turn around and use it in pet food. And it may eventually be needed for us somewhere when we're all gone as human food as well. But you know, by doing any of this recycling, they keep stuff out of landfills and they make it on Barron's Top 100 Sustainable that was done in February of last year. So they do have a lot of sustainability. They're good on the ESG as well. So let's go to our next slide. You'd never realize this, but they have to hire people, contract out with some former Texas Rangers and other people to follow people stealing the restaurant grease. They take used restaurant grease from people, and they follow this person on Inside Edition to be able to track all the stuff that he was stealing from them. And they use that to be able to make a diesel that has a lower burn point, so that it's actually much better for the environment. It's called a biodiesel, and they're in a joint venture with Valero. There's the citation from the Motley Fool, but they even have a URL on their website so you can alert people to stealing their grease. But you know, they have contracts all over on that, and so I found that really kind of humorous. That guy's on the lam too. So good things you learn. So they're really in 3 segments. They really sort of emphasize a lot of the biofuels and that you know, unused cooking oil and stuff. So that's in the fuel segment, but they're still predominantly a feed segment. They're still in the animal, you know, feeding animals with rendering and products. and then some of the other stuff in terms of the food segment, whether it's the black fly larvae or the like. But you can see with the 3 acquisitions they made in the past year, 2 of them are huge. I mean, this is only I think it only is like a 2.8 billion annual sales, and they've got 2.3 right there. But they're really sort of expanding themselves out there, and you'll sort of see it on the SSG. Those aren't, sort of biofuels that they're getting at, but they're doing this with cash, and it's going to show up, and I'll show it to you on the SSG as we get to it. So keep that in mind. Next slide. So here's the front side of the SSG. I put in the analyst consensus estimates. I put in the value lines, the one in 2026 for both sales and earnings. And I do it not to see if I can run my line through it, but once I'm done with my judgments, do I come close to this? I took out in the sales 12, 13, and 14 because they didn't really otherwise it showed up as a really great return. I think it's more sort of a classic slow part, but if you can see, really since 2020, it's been acquiring and the industry is growing itself, and you can see it with those numbers, and particularly you can see how the pre-tax profit and earnings have jumped. And more importantly, if you look down in the evaluate management, they have all greens on those trends. Now, the one that I have red circled, I'll talk about that one a little bit later. But some of those sales and earnings quarterly numbers are really a reflection of some of the acquisitions that they made. Next slide. So trying to find some competitors, I went with the ones that are up there. I ended up dropping Brunge because they just weren't really sort of competing, but it really shows up pretty well against Tyson's and much better than ADM on their pre-tax profit, and really in particular, Darling, they've really improved their pre-tax profit over the last 4 or 5 years. And that's really almost the premise for why I think it's really good, because it's really grown the pre-tax profit margin, and it shows up also on the value line. And it's consistent with what I've done with my reading. Next slide. So here again is return on equity. Though that's an okay number. It's a fair number at 10% for the 5-year average. But look at the last 2 years where it's up, at 19.7. Some of that can be because of some of the debt they're taking on, but I think they're moving in the right direction. And I forgot to mention this earlier, but their CEO has been around since 2003, 2004. So they really have the same team. Go to our next slide.
Kevin, you're
We got
cutting
lost?
out. You're cutting out a little bit, Kevin. We didn't hear anything on this debt to capital.
I was just going to start with debt to capital. I was doing return on equity, but I will repeat the last part I said is that on the front on the return on equity, I forgot to mention that the management, the CEO has been there since 2003 in that position, and their entire management team is pretty solid. This return on equity is high in this last year, but I think some of that's a reflection of some of the acquisitions that they did, and they're carrying on more debt. But I think that the whole premise in terms of where they're going with some of these additional acquisitions and trying to get a bigger footprint is sort of reflected in what you're going to see both with return on equity and on debt. Let's go to the debt to capital. So where I have that red circle, that sort of corresponds with the debt to capital that was looking good at green. It's not going to look that when this stuff rolls into the next year. And that's because they had those 2 acquisitions of cash. They didn't dilute shares. It just took on more debt to be able to sit there and move their debt from really about 33% to almost 50% debt to capital, which is really alarming. I feel a little bit better because the fact that it's a really nice core score, and I'll show it when we get to our next slide. And we will see, this is the value line. So there again is a coiled spring, but if you look down at the where do I want to see? These got sort of moved around a little bit. I'm looking for one of these. The last one should have been on long-term debt. Can you highlight the long-term debt there, Mark? Run a line through it. Yeah, there it is. So if you take it all the way out to 2020, it's at 1480. And now with this huge acquisition, it's at 3300. And again, if you project out with Value Line, they think they can cut it down by a third in just, the 3 to 5 years. So they seem to think that there's enough, enough cash flow coming in and what they're doing that they'll be able to pay off that debt. So I'm not as concerned with that debt to capital, even though it's much higher than we'd prefer. Again, realize this is a capital intensive industry that they're in, and the like. But again, if you look at sort of, Mark's highlighting the cash flow per share up there, again, look at those numbers and how much it's continuing to grow on that. It's a really, really strong thing. And with that red circle up there, that's the coiled spring. You can see it with the average annual PE ratio. There's a possibility of PE expansion, and that profit margin is going up and has moved up very well. So there's a lot of things, pre-tax profit, the debt I can understand. I think there's some real promise here. Next slide. So here's the backside. As you can see, I went with pretty reasonable high and low PEs at 22 and 10.5. And where this current PE is at 14.4, it's really close to the low. So it has a great opportunity for it to grow. It doesn't have any dividends. So it really, and the growth at 9% is just sort of average for a medium-sized company. It's acceptable, but it's really, I think, more this PE expansion possibility that really sort of stands out for me. And those are sort of my numbers. Let's go to the next slide. And so you can see I have it as a buy, 4.9 to 1, 18.6 on the high side. And if you compare that over where the par is at 11.6 on Manifest, the par is 13.5. So I think, I feel like I'm pretty much in the ballpark and pretty reasonable with where I am. Next slide. Audit, this is a relatively new feature, but like I said, I can understand, I can explain the capitalization and the debt that's there. I can explain the sales and earnings growth not being great. And then that relative value that may be looking too good to be true. I think it's more a reflection of sort of the recession and some of the economic worries. Again, I feel pretty confident with this company, again, having a good core score and having a good solid leadership team in there. Next slide. Here's my conclusion, and I just noticed this is the stuff I said last week, so I haven't adjusted it, but it's still basically, I just think it's a medium-sized steady growth. I think it's well managed. I think it's on sale, and I think it's a buy up to 73.20, and it could be a candidate for purchase. And as a full disclosure, we added it to our watch list on in the Montgomery County Model Investment Club, and my first and original club, Happy Destiny, we own it. So there's my disclosures for you. That's
Okay.
it.
Thank you, sir. Certainly a swim in the tallow, I guess you might say. Just a quick note. Many of you out there are current groundhoggers. Those that might be interested in our contest, we run it from Groundhog Day to Groundhog Day. This is a list of the leaders. By the way, the club that Kevin just mentioned is third place in the group entries, that Montgomery County Maryland club, and they're within $4,000 of the lead. I'll show you the details here. And Kevin also is just barely off this list as an individual. So we've basically been running this contest for several years now. Group entries, individual entries, and then we do have some celebrity groundhogs. The thing I wanted to focus in on tonight is our colleague, Kurt Kowitz, is actually holding down the #1 individual entry. He took over the leader position with just a week to go in the contest here in the last few days. And so we're going to celebrate that here a little bit. A little bit more about it. Again, you can read as well as anything. We believe in these things, and we like to basically compare investing ideas with our friends in this community. Here are the rules of engagement. If you are interested in participating, we select between 5 and 20 positions. You get $1 million in groundhog dollars, and as it says there, it's divided up evenly amongst your selections. There are no transactions permitted between groundhog days, and no penny stocks. Anything under $1 are not permitted. Dividends do count. dividends are in there. We use total return for it. So consider joining. If you'd like to join, you can either post it at Manifest if you're a subscriber, or send your selections to me via email. One of the things that Kurt likes to do, and he's kind of infamous for this, is he spends about 5 minutes every year picking his stocks. And he shared with us this morning, this is one of the screens he uses. He just simply goes out there and looks for companies that have high quality and high projected return. And again, he spends less than 5 minutes doing this. And if he were doing it tomorrow morning, 3 or 4 of these would probably show up on the list. He'll also take a look for triple play and stocks that are solidly in the sweet spot. You heard Ken talk about it. That's represented by all of these, which are likely to be in the buy zone of a stock selection guide. And he might shop amongst them for a 4th or a 5th entry. And then the other thing he will do is very much like Hugh McManus. He will take a look for companies that are trading within, he has 15% down here, but within single digits of their 52-week low. I went shopping amongst these trying to find an idea. The one thing that I did not find is I was looking for double-digit growth. There's really only one company here with double-digit growth, so I had to fall back to another method that he has used in the past, and that is simply pull up the company research page and look at the companies at the very top of the list. And so that's what I did. He literally in other years has pulled it up because these are actually pulled out by the sweet spot screen, and they're going to generally have pretty attractive characteristics here. So I'm going to flat out just go for the number one as an entry to our portfolio, Lululemon Athletica. I don't think the company needs any introduction, much like Under Armour and other companies in that area. It really has quite a track record, and their products are pretty obvious to those that are familiar with especially exercise rooms this time of year. Here's what the company looks like. For just a very quick summary, you look at the top line, the sales have been extremely reliable, and they're in that upper teens to 20% range. So that's check number one. The profitability of the company is pretty good. You can see very much up, straight, and parallel, pretty much consistent margins. The net margin is always hanging in there in the mid-teens. So you basically have 2 very solid parallel lines. Notice that the price has followed that earnings line pretty reliably. If you were an owner back in this time frame here, you have to have quite a smile on your face back in the high price moments of the last few years. The company's been on quite a tear. So you can see that that tear actually generated that point there where the return forecast actually approached 0. But the price has come back down a little bit. The earnings and the sales have continued their decent trajectories. So we basically have a multi-year opportunity to re-engage this company. Again, it got up to the $500 price range. It's back down around $300. So again, I'm kind of licking my wounds from the time that I brought Body Central to this body. And what was my other gem? Iconic Brands. I think maybe the 3rd time is a charm. I'm looking at this up, straight, and parallel. And oh, by the way, check out that quality profile. If that isn't a flat line EKG, the good kind of flat line all the way up at the top there. A lot of good characteristics for this company. So I'm going to go with that. Profitability, solid, continuous, almost flatlining. PEs in the 20 to 30 range. All this stuff adds up. Morningstar is the only one that's casting a dissenting opinion. The regular analyst consensus actually sees just the opposite. They see it as dramatically being on sale. And just a lot to like here. Absolutely no debt. So we're going to go ahead and add some Lululemon Athletica. And no, Ken, you're not allowed to imagine me in yoga attire.
Believe me, Mark, I'm not.
So
I want to see a photo of that.
All right, so go ahead with the poll, Ken.
All right, we're going to launch this poll. Make sure I get the right one. Here we go. And if you'll give us some help in the audience by voting for the one stock that you'd like to add another lot in. You don't have to vote for any of them. Give us a none of the above if you don't like any of the four that we've presented this evening. We're up to 3/4 of you voting already. We'd love to get that voting up to 85–90%. There it just hit 83%, 86, 87%. That's fast tonight, folks. You're really right on the ball. I'm going to count to 5 and then close the voting down. And with 90% voting,
Adobe wins.
we have a clear winner of Clearfield.
Oh, no pun.
First Foundation and Lulu and Darling all taking roughly equal shares there.
So we split the ticket again.
Well, if you're going to let me do that all the time, you know.
Mark, even if we put all three of us together, we still don't beat them.
Well, I know. We got to come up with a way to bring in.
It's the
a group.
baseball guys against the non-baseball guys, and the non-baseball guys won.
Yeah.
Help.
It's that hot stove thing again.
Apparently, yes, we got burned.
We all got burned.
Okay, I hid the results, Mark. You can continue. Okay.
All right, let me continue. I think I'm back now, right?
Yes, you are.
Okay. Again, this is your reminder that we do archive all of these sessions on YouTube if you want to go back and catch some of those links that were being tossed around. We also put PDFs of the session in the Manifest forum and be happy to mail to anybody who wants. But again, you can go straight to YouTube and get these sessions, including the bull sessions. And that session that was mentioned about the real estate stuff, that's right here. The real estate residential construction industry study is right there, shown on the slide. Please hit the subscribe if you'd like to be notified anytime new content is added. As far as stuff coming up, again, we haven't rounded out all of our stuff yet, but the February roundtable will be on the 28th. That is our black tie affair. Again, golden statues will be dispersed. And that one just is a whole lot of fun looking back at over 12 years of the roundtable. Ken and I still are on the docket for a date to be determined for Southeastern Michigan with AAI. And we do have lockdown presentations. These are face-to-face, and we're just happy that those are returning to the mix. Cincinnati in April and New Orleans shortly after we finish Halloween.
We should give publicity also, Mark, to mid-August when Atlanta will run the Georgia Investors Fair. Cy, do you have an actual date for that Georgia Fair?
Yeah, let me see if it's in August. Let me see if it's on my calendar yet.
I'm
August
checking
the
my
19th.
calendar. There we go. Okay, August the 19th.
Yeah, August 19th.
Okay. I'll go ahead and add that for the next month.
And I don't know, Cy, will that be fully virtual, or what exactly are
As
the
far as
plans
I
at
know-
the moment?
As far as I know, that is in person. It was in person last year.
Yep,
And,
that's what I have on my calendar. It's an in-person date.
Mhm.
Actually, I have it starting on the 18th through the 20th, but that might be when I'm flying, Mark. So we'll focus on the 19th, as I said. Okay.
In any event, it's August, and we'll firm up the details on that one as they materialize.
Okay. If you're in a chapter out there that would like a visit, don't be afraid to drop us a line or give us a call. We'd love to start visiting in person again. And Jennifer's asking, do we have dates for BINC yet? Bink is going to be virtual this year. It's going to happen on the first 2 Saturdays in June. And that's about all the details I have at the moment. But if you watch the Better Investing website, I'm sure that as instructors get named and as classes get decided, I'm sure that all those details will be posted on the Better Investing website. All I know right now is that we'll be virtual, and it will be the first 2 Saturdays in June. And there will be quite a selection of classes on each of those Saturdays for people to take a look at. No other details past that. Anything else for the good of the cause, folks?
Just one quick thing on the financial health grade. Thank you, audience, for educating me. I was not aware. I've been a Morningstar subscriber in the past, and I have access to Morningstar reports now, and their quantitative reports have never contained financial grade, any grade, financial profitability grade. And I was not aware that apparently they give that grade and that you can access it through the BI screen. I did double check the reports just to make sure I hadn't missed something, and the reports still don't contain it, unlike the analyst reports. But you're correct, it's in the grade. And Joe Farrell mentioned in the comments box that they've rated, I think Joe said most banks a D. I'm not sure that was true when I looked at but there's an awful lot of Ds. Most banks are in the C's, D's, with a smattering of F's and B's. So that's where Morningstar does right now.
Susie Artsberger has mentioned a couple different times in Ticker Talk programs that those grades are proprietary, coming from Morningstar, and we get them as a subscriber to the database, and they're over and above material that goes into their own website. Okay. So you won't find it if you are just a normal subscriber. The only place that you're going to find it easily is right through the subscription that you're entitled to when you become a Better Investing member.
As a follow-up on that, I have been looking at those stock grades and stuff, and I'm started to put together a presentation on it. I've been able to dig into the Morningstar site to find it. Yes, you're not going to find them on the individual company reports or anywhere up on their site.
With the exception, no, if you have the premium reports and they are an analyst, they do have the grades.
Okay, I haven't seen it. I'm using the library edition for Morningstar, so they may not be up there.
Yeah.
Mark, I'm searching our questions here. I don't see any immediate questions. I want to thank Cy and Kevin. Both of them have done a nice job in taking care of quite a few of the questions that we have. So I think we're pretty well caught up, and we're able to wish everybody a real happy new year. We hope we see you on the last Tuesday of the month in February. That'll be February 28th, and that will be the next scheduled roundtable program, and that'll be our annual meeting of the roundtable with all the awards for best performances given at that time. Right, Mark?
Absolutely. And that background noise that you're hearing behind me as I'm presenting, that's the trophies, the trophy shelf being built. So I'm expecting.
Don't engrave them yet.
Is that a little foreshadowing, Mark? Is that what that is?
Actually, what that is probably flushing any hope that I have down the toilet.
All right, good. So with all of that back and forth, I'd like to really thank Cy and Kevin. Guys, the kind of work that you do for Better Investing can't be minimized. Thank you so much for being such loyal volunteers. Mark, you know how Mid-Michigan feels about the things you do for us and for the entire community, and I think we'd be lost without you a lot of times. And on behalf of the Mid-Michigan chapter of Better Investing, I wish you all a great winter. Find somewhere warm to hibernate. Any other last comments, gentlemen?
The only other thing is Kevin and I will be, Kevin's going to pinch hit for Ken next Tuesday at Bull Sessions. So I think it's going to be an entertaining session. I don't think we're going to be talking about rendering roadkill. So
All right.
But we can talk about black fly larvae
we could.
All right.
Thanks,
and how it
guys.
would be a really good protein for you to have.
Okay. Now,
All right, well, you
now
can
it's time
convince
to
me.
close everything down, okay?
All right.
Good night, everybody.
Good night,
Thank you
everybody.
so much.
Thanks.
Good night.
Good night.